Good morning, Bitcoiners, and welcome back to your economic calendar for the week ahead. Today is Tuesday, September 27th, and we have a very busy week in the markets coming up. This week, we get 13 Fed speeches, including 2 by Mr. Jerome Powell, chairman of the Fed himself. Speaking of the Fed, markets are still dealing with the aftermath of the Fed's decision last week to raise interest rates by 75 basis points. Now, while the amount, the 75 basis points, was very much expected by investors, it was the Fed's commitment to keeping rates high for a longer period of time that caused some investors to basically go and adjust their portfolios. The news has sent interest rates for US bonds soaring along with the US dollar. And the soaring US dollar has caused havoc in foreign currency markets, as well as introduced some volatility in most asset prices and markets in general. In this issue, we're going to cover how asset prices have reacted after the Fed decision, why some assets have held up better than others, and what this could mean for these assets going forward. So, lots to cover. Grab your coffees. This is going to be a great one today. So, to recap, last week, the Federal Reserve announced a 75 basis points increase to the overnight interest rate. Although many investors were expecting 75 basis points increase, as we covered last week, what caught some investors off guard was the fact that Fed officials issued a consensus view that interest rates need to remain above 4% for all of 2023. And many investors were expecting that the Fed would start cutting rates at some point in 2023. So this delay of the pivot from raising to cutting is what's causing most of the readjustments in markets that we are seeing. A good example of this would be the fact that US bond rates are soaring after the fact. And with that, the US dollar has gone soaring. As we've covered in the beginning, this has introduced a lot of issues in the foreign exchange markets, particularly in Europe. And it has also introduced volatility in many asset classes with big benchmark indexes like the S&P 500 and the Dow Jones testing the lows from June. So in today's issue, we're going to basically review or look at how different assets have responded or reacted since the Fed announcement. We're going to look at why some assets have held up better than others, and we're also going to look at what this could mean for these particular assets going forward. So let's get into our analysis. Now, let's take a look at how some assets have performed since the Fed decision. The chart on your screen tracks a select group of assets ranging from Bitcoin to the US dollar index, some sovereign currencies, market indexes like the S&P 500, and even gold. So let's go one by one. First, let's talk about the US dollar, which is the green line on the screen. As you can see, the US dollar has been a clear winner since the Fed decision, up 3.4%. That is the US dollar index, which is a basket of currencies that the US dollar trades against. And this has broadly rallied on the back of soaring bond rates for US bonds, US Treasury bonds. All US Treasury bond maturities, all the way from 1 month to 30 years, are now in positive real rate territory. What this means is that the interest rates that these bonds pay minus the expected inflation for that time period are in positive territory. And this is actually something that the Fed was very much looking for, and it is a sign of progress in the sense that these rates were not in real positive territory a few months ago. They just got here because the Fed has been raising rates so fast and dropping inflation so fast that the rates are now in positive real territory. Why this helps the US dollar rally is because now you can hold US dollars and earn interest from the Fed in a risk-free way, and it is a real interest payout, meaning that what you get minus inflation is still positive, which was not the case a few months ago. So this has helped the US dollar rally, and again, we see that this has actually put pressure in other sovereign currencies, which is the next point that we're going to touch on. Let's talk about sovereign currencies like the Great British Pound, the Euro, and the Canadian dollar, just to name a few. Yellow Canadian, purple is the US dollar, and you can see the Great British Pound here in the teal color. The Great British Pound in the teal color, you can see, is down almost 6% since the decision. It's down 5.40%. The euro is down 3.51%. And the Canadian dollar is down more than 2.5%. It's down by 2.68%. These currencies are all crashing against the dollar. Keep in mind, this was less than a week ago, and the Great British Pound, the euro, and the Canadian dollar have all lost in multiple percentage points just in 1 week. These are just a few currencies, but it is happening with virtually all other currencies. The vast majority of them are melting against the US dollar. What this tells us is that investors are looking to sell their local currencies for US dollars before the purchasing power of that local currency drops even further, as the Fed has basically signaled that it will continue raising rates. This will continue making the US dollar stronger, and investors are anticipating further weakness in their local currencies, and they're basically trying to get rid of it before it loses any more of its purchasing power. So that's on the sovereign currency side. If we look at equity markets like the S&P 500 and the Dow Jones, but S&P 500 that is on this line here on orange, we can see that they have also been hit quite significantly. The S&P 500 is down 5.7%, and we're going to touch on a few of the reasons why the S&P is reacting this way in our S&P section briefly after this. Even gold, denominated in US dollars, which is this purple line that you see here, is actually down about 2%, 1.7%, since the Fed announcement. And this is not surprising, as gold has historically had a negative correlation with real yields in US bonds. And the real yields of these US bonds just got a lot better last week based on what we just discussed. And the reasoning here, again, is that when real rates for bonds, US government bonds, are positive, investors tend to ditch gold for dollars, as holding gold does not pay interest while they wait. And holding dollars at the Fed or through US government bonds does pay you real interest as you wait. Now, having covered all of these other assets, this brings us to Bitcoin, which is actually the best performing asset, on the chart here. The only asset that has performed better than the US dollar. A lot of that has to do with the move that happened overnight and earlier this morning. But again, Bitcoin is basically holding up better than most assets since the Fed decision. And we wanted to share a few hypotheses as to why Bitcoin could be holding up better than the rest. Now let's go over a few hypotheses as to why Bitcoin could be holding up better than other assets. Hypothesis number 1, Bitcoin's availability and transferability. And I'll explain. Buying Bitcoin can be a proxy for buying US dollars in the emerging world. And it is readily available in most of the world because it has very liquid peer-to-peer markets in most economies, meaning that Bitcoin is readily available for purchase in most places. And it can also be easily transferred to a different account, to a different jurisdiction, if you were looking for protection of those assets. So these two attributes make Bitcoin a great option for people that are looking to protect their purchasing power and may not have immediate access to, say, US dollars in a digital format, because a lot of times holding that US dollar in cash can be a big liability in those markets as well. Hypothesis number 2, Bitcoin's superior US dollar liquidity and property rights. And let's explain. As foreign currencies come under pressure, though the assets in those local economies, the prices, the real value of those assets in dollar terms for those local economies will also come under pressure. And moreover, these assets are many times very difficult to sell for US dollars, which is eventually the end goal of where a lot of people want to get to. This is not the case for Bitcoin. Bitcoin can be readily sold for US dollars in many markets globally, and therefore it has very, very strong US dollar liquidity, which makes it a great candidate for somebody that is looking to purchase an asset to basically get dollars at the end of the day. And it cannot do this by using, say, local real estate or other local assets. And moreover, as economies are about to come under pressure, it is likely that people fear for the property rights of their assets in these economies. Therefore, Bitcoin having much stronger property rights many times than real estate or other assets in these local markets makes it a great candidate for someone looking to protect their savings from movements in foreign currency and potentially local assets. Now that we've covered the hypotheses, it's important to ask, so what? Well, if these hypotheses prove to be true, or correct, then it should lead to the following. Number 1, it should lead to stronger volumes in the Bitcoin spot markets as more participants become active from different parts of the world. Side note, higher liquidity, which means more people transacting, typically leads to lower price volatility, which could be a secondary benefit of this. The second knock-on effect could be a growing number of daily active addresses and addresses holding non-zero balances on the Bitcoin network, which again would reflect the number of people basically using Bitcoin to protect their savings during this period. And number three would be that if this holds true again, we should see positive growth in the total supply and user count of US dollar pegged stablecoins. This should happen over the next few weeks and months. The reason for this is that it's only really been a week since the Fed decision, so on-chain stablecoin supply could not be yet fully reflecting the potential new demand. In addition, stablecoins are not typically as liquid or easy to buy in most economies as Bitcoin is. But again, this is because Bitcoin has had many more years setting up all this buying and selling infrastructure. Now, we will continue to report and track the progress of stablecoins, including total supply and user count, and we'll continue to report here on the coming weeks and months as they could be very meaningful implications to this. Now, checking in on the S&P 500 and equity markets after the decision, we wanted to share two very interesting insights or data points from last week. Number one is the fact that Goldman Sachs last week announced a change in its target for the year-end S&P 500 goal, which is they moved this target to 3,600, which is very consistent with the targets we have been sharing in the past few weeks from the analysts from JP Morgan and Bank of America. The other interesting piece of news was the fact that last week there was a record number of put contracts for the S&P 500 bought or changing hands. And this is important because many investors have already sold a big deal of their portfolios in this environment. And a material amount of other investors that remain in the market just purchased downside protection for their portfolios. This means that there may not be that many motivated sellers left, which could help keep asset prices stable or near current levels in the near term. The other interesting fact here is the fact that now Goldman Sachs is converging with that S&P 500 goal at 3,600, which is very close to Bank of America and very close to JP Morgan. We're starting to see a convergence of analysts around this level, which means that if more and more analysts continue to converge around this metric, this could set a psychological goal for investors for the end of the year, meaning that there could be more willingness to buy dips below this level, again, helping to keep prices more stable between now and the end of the year. Now, as always, we wrap up with a summary of what you can expect for the week ahead. The week ahead is packed with Fed speeches. We have 13 speeches from 11 different officials, including 2 speeches from the Fed Chairman Jerome Powell. One of them just happened today. We are also going to get another read on U.S. inflation through the Personal Consumption Expenditure Index, which is a metric that the Fed follows very closely. Before we get into the details of these speeches and that data, we're also going to talk briefly about another event that might generate headlines, which is the potential upcoming stablecoin legislation that is working its way through the US Congress. There has been a lot of conversation around US policymakers about potentially what this bill could entail. And this conversation will likely get louder and culminate in some form of stablecoin regulation. Now, this outcome should stand to benefit stablecoin operators that are very transparent and compliant, like Circle and USDC, which is the stablecoin we support here at Ledin. And it should also benefit the industry overall because it will introduce protections and assurances around stablecoins that will make millions of people feel more comfortable to transact or interact with this new technology. With all that being said, let's take a look at what we can expect for the week ahead. So today, Tuesday at 6 a.m., we just got the Chicago Fed President Charles Evans giving a speech. We also got one from San Francisco Fed President Mary Daly. And today we'll also get the S&P Case-Shiller Home Price Index to show how the U.S. real estate market is progressing. At 10 a.m. Eastern, we also get another Fed speech from St. Louis Fed President James Bullard. And at 11 a.m., we get Jerome Powell participating in the Bank of France digital currency event. Now, tomorrow we get 4 Fed speeches. 8:30, Atlanta Fed President Raphael Bostic. 10:15, Fed Chair Jerome Powell. At 11 a.m., we get Fed Governor Michelle Baumann. And at 2 p.m., we get Chicago Fed President Charles Evans. On Thursday, we get a reading of the U.S. gross domestic product and a speech by Mr. James Bullard, St. Louis Fed President. And lastly, on Friday, which is a big day, we get the Personal Consumption Expenditures Index, another reading of inflation in the U.S. The expectation here is for a 0.1 month-over-month increase and for a 6% year-over-year increase. Look for markets to react negatively if the number comes above and positively if the number comes in line or below. Then on Friday, we also get 4 Fed speeches. We get Fed Vice Chair Lael Bernard. We also get Michelle Baumann speaking on bank supervision. At 12:30, we get Richmond Fed President Tom Barking speaking on what's driving inflation. And lastly, we close with New York Fed President John Williams at 4:15 talking about financial stability. That, again, is all on Friday. With that, we've reached the end of today's show. If you enjoyed it, if you learned something, I welcome you to like it, subscribe to the channel, share it with your friends. If you don't yet have a Ledn account, I welcome you to check us out at ledn.io and learn how you can start earning the best interest rates for your favorite assets, Bitcoin and USDC. We also have the best rates for dollar loans backed by your Bitcoin if you need liquidity and don't want to sell. And our most recent product, the Bitcoin Mortgage, lets you buy a house as big as your stack. Thank you, everybody. See you next week y los quiero mucho.